Today we will be looking at annuities. An annuity is a contract under which a series of periodic payments are made. What normally happens is that the policyholder goes along to the insurance company and pays a single premium, also called the purchase price, and in return the insurance company promises to pay an amount at regular intervals. Now this amount may be a level amount or it may be an increasing amount depending on the contract. And also the payments may be paid for a fixed period or it may be paid for the whole lifetime of the annuitant, which is what happens under a purchased life annuity. So it really is a way of converting capital sum into a series of payments. An annuity may be paid or may be purchased by an individual, as I mentioned earlier, or it in fact could be purchased by an organization for a group of individuals. In other words, a group contract may be affected as well. With regard to how these annuity rates are concerned, in other words, how the insurance company determines how much pension to pay in return for the purchase price, that is dependent on mortality studies, which lead to the creation of mortality tables. What a mortality study does is to look at a group of individuals consisting of people of the same age, of the same sex, and see at a given period how many people die, over a given period how many people die, and from that they can work out what is their liability going to be if they offer an annuity to a particular individual. So we see that the risk of living too long can be covered through this type of contract, especially one where the annuity is payable throughout the lifetime. It has been noted people who or purchase annuities live longer than people who purchase life insurance policies. Now why should that be? Someone who is interested in purchasing an annuity contract is someone who is concerned about living too long or running out of his capital before he dies. So he goes along and purchases an annuity for his lifetime. On the other hand, someone who is not well, in poor health, thinks that he's not going to live for too long, and to protect his family, decides to purchase an insurance policy. So there are two different. So that indicates that there are two different types of people who go for these two different types of contract, and there's a reason for the anti-selection under different circumstances. And of course, it's clear or it's evident that someone who is older is likely to get a higher rate of annuity because they have that many less years to live. And also it's been the studies have shown that women tend to live longer than men, and what that translates into is that insurance companies will offer a lower annuity rate for the same age to a female as opposed to a male. However, there are pressure groups who, as far as annuities are concerned, pension annuities are concerned, are saying that no, the same annuity rate must be offered to both sexes at the same age. And some countries have in fact started to adopt this. Otherwise, the insurance companies are being told they are being age discriminatory. So as far as the specific calculation of an annuity rate is concerned, apart from mortality, the other factors which are taken into account include obviously the purchase price, in other words the initial investment, the period over which the investment accumulates. For example, if someone is buying a deferred annuity under which the annuity doesn't start until after a particular selected period, then there is that period, the deferred period is there to accumulate the investment, so the rate is different there, the annuity rate is different. The other factor is of course the interest rate available in the market, and then we have the frequency and number of payments. In other words, how often is the payment made under the annuity contract, and how many payments are made. So if we have a annuity which is payable say monthly, in other words 12 times a year for 10 years, then that is going to be different for an annuity which is paid once a year for 15 years. With regard to the tax position, if the annuity is for the purchase for the provision of pension, then a lump sum may be taken at the vesting age, which could be up to 1/3 of the benefit, and that will be tax free. And also, when the annuity is purchased, there is another tax benefit in that under 80 CCC, a deduction is available. So what are the different types of annuities? Broadly, there are two different types. One is the immediate annuity, and there is the other deferred. The other is the deferred annuity. As far as the immediate annuity is concerned, the annuity starts immediately after the end of the agreed payment interval. In other words, if you have an immediate annuity with a half-yearly payment period, then it would start once the first 6 months are gone. If you have an annuity which is payable monthly in arrears, then it would start after a month period has gone from the date of purchase. And then we have, as I mentioned, we have the deferred annuity, under which the annuitant or the policyholder would select a deferred period during which the investment accumulates, grows, and following which the annuity starts. So you could have a deferred annuity of say 10 years, then no annuity will be paid for 10 years, and then once the 10-year period is gone, the annuity will start. The further types of annuities or further classifications of annuities include an annuity which we've already mentioned, which is the annuity payable for life. It's also known as purchase life annuity, under which once the payment is started, it will continue until the death of the annuitant. We also have the annuity certain, under which the payment is made for a fixed number of years as agreed under the contract, regardless of whether or not the annuitant is alive. So we have an annuity certain, for example. The payment would be made, annuity certain of 10 years, the payment would be made for 10 years, and if the annuitant were to die or the policyholder were to die within the 10-year period, then the remaining payments would be made to his beneficiary. We also have a combination of the earlier contracts mentioned. For example, we could have an annuity certain and thereafter for life. So what would happen under that would be the payments would be made for a fixed number of years, and if the policyholder were to survive that period, then the annuities would continue until his death. Another type of annuity is the annuity certain with return of purchase price. What happens under that is the annuity is paid for a fixed number of years, and then the purchase price is returned to the annuitant. We also have the variation of annuity for life with return of purchase price. Under that, the annuity is paid as long as the annuitant is alive, and in the event of his death, the purchase price is returned to his nominee. Another variation is the joint life annuity. So where we have a husband and wife, the annuity is purchased on both their lives. So let's say the annuity will start and it will continue until the death of the husband, but then it will again carry on. It will still carry on rather until during the lifetime of the wife. The variation on that would be a joint life annuity with return of purchase price. So it carries on during the lifetime of the husband, carries on during the lifetime of the wife, and then on the death of the wife, the purchase price is paid to the nominee. Let's to look at an example of contract which is available in the market with this sort of annuity features and so on. If we look at the ICICI Prudential's Life Link Super Pension, it's really for people who want to invest a single premium towards the pension provision. It's a unit-linked contract. The minimum premium that's accepted is 25,000. The annuities which it provides are several. In fact, there are 5 options available. The first is the life annuity, under which the individuals provide an annuity for life. Then there is the life annuity with return of purchase price, which we have already covered. Then we have a life annuity guaranteed for 5 years or 10 years or 15 years. This is the equivalent of this annuity certain. What that means is the annuity is paid for the period selected regardless of whether the annuitant is alive, and then it carries on for the rest of the lifetime of the also offers a joint life last survivor with return of purchase price. In addition, it has the option of a joint life last survivor without return of purchase price. Now the difference between the two would be that the one which does not allow a return of purchase price, the annuity rate or the pension payable for the same purchase price would be higher. Again, as far as the tax benefit is concerned, under this type of policy, under this type of contract, up to 1/3 of the accumulated value may be taken as a tax-free lump sum, and also the premium, the original premium which was paid, would receive tax relief under section 80 CCC. So we'll stop there for today. Thank you.